Hi, let's learn about federal taxes that affect the sale of real property.
Federal income taxes from the sale of real property. Owning property and businesses have an impact on federal income taxes. Some of these are tax incentives to encourage home ownership. On the other hand, there may also be taxes charged upon profit realized from the sale of property. Sale of real property. Real property is a capital asset. It is described by the federal government to be any property held by the taxpayer. Therefore, it is subject to capital gain or loss rules and taxation. This may involve tax on principal residences, investment residential properties, and commercial or industrial properties. Amount realized. As explained in Section 17, capital gain is profit from the sale of real property. Capital gain is calculated by taking the amount realized from a sale, which is sale price minus expenses to sell, minus the adjusted basis of the property. If this is a positive amount, then it is a profit. If it is a negative amount, then it is a loss. Capital gains or losses are reported on federal tax statements. However, capital gains may be tax exempt depending upon IRS parameters. See subsection 2. Taxable gain is determined by the amount realized from the sale. Sale price minus expenses of the sale is the amount realized from the sale. The adjusted basis is the owner's original cost plus expenses of purchase and capital improvements. Capital gain is the amount realized minus adjusted basis. Amount realized, example 1. A homeowner sold his house for $225,000 and had selling expenses of $13,500 total for broker's commission, doc stamps on the deed, and owner's title insurance. The owner's original cost was $180,000 for the actual purchase, with $7,750 in purchase expenses. Plus, the owner made capital improvements of $18,000. What was the owner's amount realized from the sale, adjusted basis, and capital gains? Solution Part A. What was the owner's amount realized from the sale? Amount realized equals sale price minus expenses of the sale. So the property sold for $225,000 and selling expenses totaled $13,500. So $225,000 minus the expenses of $13,500 equals $211,500 as the amount realized for the sale. Part B. What was the adjusted basis? Adjusted basis equals the owner's original cost plus expenses of purchase and capital improvements. The property was purchased for $180,000. Purchase expenses totaled $7,750 and capital improvements were made totaling $18,000. In this case, we don't have to worry about any reported depreciation as that's not being included in the story problem. If it was, then we would subtract that at this point as well. So we take $180,000 purchase price plus the $7,750 in expenses and add the $18,000 in improvements to equal $205,750 as the adjusted basis. Part C. What was the amount of capital gains or loss? Capital gains equals the amount realized minus the adjusted basis. So we have $205,750 amount realized from the sale minus $205,750 as the adjusted basis to equal $5,750 as capital gains.